Hello, everyone. My name is Ben Peters from Advanced Trading, one of the commercial brokers here, and I'm going to give a spring outlook as it pertains to markets, mainly corn and beans. Recently had a USDA March monthly report, and that report turned out that in the US, the corn, beans, and wheat numbers were, for the most part, unchanged. If you look at the individual corn balance sheet, they didn't do anything to change from Feb to March except a little bit of a shell game on feed and industrial. It's kind of a 5 million bushel swap, but the end numbers were unchanged for old and new. And on beans, it's exactly the same thing. So they effectively took the month off. They did, however, do some things with South American numbers. They increased last year's production 2.5 million tons on beans. This year's 1 million tons. But at the end of the day, the world soybean stocks only went up a little less than 1 million tons. So some positions squaring up. Other notable in that report was they did change some Chinese numbers. They increased the Chinese wheat feeding 5 million tons, which is pretty significant. That's 200 million bushels of wheat being fed. That wasn't really on their balance sheet. And of course, that has implications to corn. And then the soybean crush, they dropped 1 million tons, and they dropped their domestic meal consumption about 800,000 tons. So I'd say that's a touch bearish, the complex, but just notable. So what I'm going to do today is just jump into S&Ds. Most of this information you can dig out of the numbers, and I've just put it in some slides. And first wanted to start by going back and looking at 2020 and this incredible year we just had with respect to COVID. And how it affected the world and everybody, and of course agriculture. And then look at the ag situation specifically, and then get forward here. Talk about the things that are going on our influx that will change markets, that the market's sensitive to. So without that, we'll get on. First, looking back, if you look at the Dow Jones going back, the last really 10 years, it's just been a growth market humming. You could see that also in the jobs, because since 2008, our unemployment or U.S. unemployment rate, as people are just getting to work, getting down as low as we've seen it in pretty much all sectors, all demographics. And people with that good economy and being employed, this is motor fuel consumption, gas demand. This is the year coming into COVID, and we were on pace to trump anything we had done in the past. So just good demand for corn and ethanol through good gasoline demand. And then along came COVID in March, and we call that a black swan event. We had a couple of those in 2020, or that crop year. Black swan by definition means you can't predict it. It just came out of nowhere, and it affects a lot of people, can affect a business plan despite all your efforts. So these are the kind of things that in agriculture, you always look back at the end of your management, at your portfolio, and say, if I didn't have any ability to predict anything, what happens if corn goes up a lot or goes down a lot? Am I protected? Am I managing unknown risks that could be a black swan event? And that's what we like to try to do when we stress a flat price risk position. So looking at this black swan event, in March, we had this massive break, and the Dow went from 30,000 down to below 20 quick, and then a big V recovery as people locked down and adjusted to it, and the market started to look at the future. And the drop was fast, but the recovery was was just as fast. Looking at the unemployment rate, jobless claims, of course, jumped, and unprecedented move. People just, I guess you could say, were furloughed. Of course, PPP encouraged people not to furlough, so the recovery took time. We got into summer, and yet this year we're still not fully recovered with unemployment. We need to get service industry and travel industry and leisure industry back to work, and people spending money outside of online buying. No industry, no country was safe. Everybody was impacted. If you look at GDPs, we had a contraction across the globe. The average world reduction was 4.8% in gross domestic product. So looking at egg markets, one of the things we looked at and talked about was gas dropping, literally from almost 10 million barrels of finished gas demand, it cut in half. People just stayed home. They were told to stay home. And then they learned how to work at home, and companies encourage that. And so with that, it's just less corn needed for ethanol because you blend it into half the usage. So if you look at other things that happen because of the lack of energy demand, gasoline, crude oil for refined fuels, if you look at it, it was at 45, 50 bucks a barrel, and then it dropped and slowly ground down into that 20, and I kind of a little tongue-in-cheek quote from a random trader, if you will: crude's a buy. What's the worst it could do? Go to zero? Well, when crude oil inventory demand dropped so much, we actually filled all of our storage. And people that thought that getting long could only go to zero, so to speak, there were trading firms that thought it could only go to zero. Found out that it could actually go negative, because to own oil means you got to put it somewhere. And if there's no place to put it, the cost of storage is something people try to get away from, so they sell it to negative numbers. So that was quite a period, historical period. Another black swan event within the black swan event, the dairy industry equivalent of that is dumping milk. When demand goes down for restaurant hard cheeses, whatever, fluid milk, just general demand, you can't store milk. And if you look at like eggs, at first reaction in the COVID was prices jumped. There's fear and panic buying, Easter coming along. If you remember going to the grocery store, having somebody go to the grocery store with you, bare shelves, people were hoarding eggs and meat. And I mean, I went to my local butcher shop to buy meat because IV and the other stores had no meat. And so, as you know, the panic buying, and then of course the processing challenges, costs went way up, price of meat went way up, somewhat because of the hoarding, and then of course because of the cost to keep employees in these kill floors with dealing with COVID, so forth. The Dow Jones, as I mentioned, rallied, and we're back. I think right now today, we're within 50 points of an all-time high on the Dow. I think the S&P were close to that too. NASDAQ recently had a setback. I think the techie stocks, they're pulled back because there's just too much buying going on, too few assets. And again, if we already talked about gasoline demand, we are not back to pre-COVID levels. So looking forward at the ag markets, let's get into some of the things that are going on, mainly that the funds, of course, have been buyers, in some cases to record levels, because we're starting to have this demand for beans, oil, vegetable oil, wheat, anything, egg, cotton, corn has been amazing. We'll talk about that. We've had some supply challenges, and then of course politics across South America. big story is usually rooted in what China is doing and demand for everything. Just get the fund chart out here. If you look back to the last year to the current week, it's interesting. If you look at just the net managed money, what you call the large spec corn is red, they were below the line short after COVID hit, got pretty short. If you remember, we had a 3 billion bushel carryouts estimated on corn, just a glut of corn. And then all of a sudden the US numbers started to get trimmed, and China started buying corn, and world stocks tightened up pretty incredibly as China bought a lot more corn than we thought, even late here in November, December, and January. So the funds are long corn. They've been long a little bit of beans through the late summer and into early harvest for us, but they've been long beans for quite a while. And then of course they're long record amounts of soybean oil and meal. Looking forward at the South American story, corn and bean fundamentals, there's just a lot bound up in South America. As you know, they raise about 7 billion bushels of beans compared to our 4.5 billion bushel beans. So not quite twice, but a big producer of beans. That's a company or a country that's still trying to build infrastructure, the logistics, the barge and vessel loading, the labor force, and even roads to get the stuff out. They've had improvements, but a lot of the capital goes into the land improvements, and then everything else seems to be downstream. So there's a lot of stories involved, from trucker strikes to currency devaluation, which for the Brazilian farmer actually means that they get more for their beans because they sell them exports in US dollars, and then they get back their local currency, more of it when their currency is weaker. But the main story here has been mainly what's the effect of La Nina has had on South America. So just a real quick generalization of the pattern changes when you have a La Nina. Usually the Brazil is from June till the following March is wet. Now, wet is usually a good thing there. It means you're producing stuff. If you can get it planted and you can get it harvested, it usually means you have a lot of stuff, good crops. And then in the southern part of South America, getting down in the Argentine area, usually that means dry in August, September, Dis. Not necessarily hot, but from a moisture standpoint, weather pattern, they can struggle with dryness, and those things have happened this year. The La Nina has impacted Brazil and Argentina. Let's talk about Brazil. First of all, Brazil, they had a wet spring, as La Ninas often do, and they just didn't get their beans planted in a timely fashion. So when you push the bean planting back, what it means is that it means when beans are harvested, it'll be later. And Brazil plants a lot of their corn crop as a second crop to beans. And so in a nutshell, when the beans get in early, it means the beans can be harvested, corn can get in early. And the reason that's important is that second crop corn, which is 3/4 of the Brazilian corn crop, is now beans that are followed by corn to raise what's called the safrinha, or winter crop, meaning when that crop is planted, and then as it matures and goes through vegetative, usually it finishes in late May and June. And if the crop's put in late, it's more June, maybe early July. Well, they just flat out don't get any rain. I'll show you that in a bit. So this is a chart about a month ago now, just giving you a feel when we normally are harvesting a lot of beans. This year we were well behind, on 15% harvested on this mid-Feb. and that's just well off a pace. And you could see, uh-oh, that's a problem. Let's look more at Mato Grosso, one the largest bean growing state there, and then second crop corn after it. If you look at mid-Feb, they only were at 21% harvested, where normally their 5-year average is 47. So again, just delayed bean harvest from a delayed bean plant, which means a delayed corn plant. And then moving forward here, currently they're still only 70% done with their bean harvest. It's just been wet. There are parts of Brazil that have had literally over 20 inches of rain in the month of February. In fact, there's a declaration emergency being requested on about 3 million hectares, 7 million acres of beans that just aren't finishing because they're staying rotten in the pod. So that story is still being told. It's why funds remain long. We'll see what the Brazilian crop does and how it finishes on beans. And of course, more importantly, since we're planting the corn crop so late, we virtually get zero rain in June and July, and this story is well ahead of us. And again, this will be about the time you come into pollination in North America. So just lining things out here, this story, which is of Mother Nature, both in South America and North America, is probably the big story for the rest of the year, because demand is known, it's robust. This is a demand-led market that we're having problems and potential higher risk to finish to meet the demand, both with the South American crop and then of course the US crop. We have a little bit of drought that's on the Palmer, mainly creeping in from the Western Plains. As I speak, we got a big storm system that's supposed to lay a lot of moisture here Thursday, Friday, Saturday, Sunday, from the mountains all the way to Missouri, including Kansas, Oklahoma, and Colorado. So we are actually helping the US weather here in winter. So moving forward, if you look at the demand side of things, you kind of, this chart is it shows Chinese corn price in, effectively it's in yuan, but I converted it to dollars per bushel. If you look as we go through the 2021 here, from just the Jan on, we have rallied corn to about 11 bucks a bushel. That's an indication of their domestic price, of domestic stocks being tight. The market tells you, a lot of times you can't trust the numbers they put out, but when you see the cash values, you know corn is tight, it's in demand. And when corn is tight and expensive, they should look to import it. Usually they try to draw with on their own reserves, but they had recently, several years ago, pulled their reserves down, went to a more market-based program to supply themselves. And then they had COVID hit and swine flu hit, and they have changed their policy back to trying to build a reserve up so that they can avoid being dependent on foreign soybean meal and soybeans for their consumption of and growing of hogs. This chart shows you Chinese corn buying since last harvest, and they have bought 8 million tons added to it as we went into through our harvest into the new year. And then recently, you remember the week where they bought 40 million bushels in one purchase, largest ever. So they're spiking up, approaching 800 million bushels of Chinese corn buying through exports, which of course we are benefiting from a lot of that. I want to back up a little bit just to show you. If you look from last May, if you look at what corn prices have done, this is May corn, and you see they've gone from about 350 up to 525, 550. And down below, as we went through monthly reports, I just wanted to show you what our carryout was and what our stocks to usage ratio. And if you remember back in May, June, July, we had almost 3 billion, over 3 billion carryout. And then we started to reduce that from our crop issues and demand picking up. And then the stocks to usage, of course, tightened up from 22% down half of that carryout dropped from 3.3 down to 1.7, half, and we continue to tighten up the carryout to the last report here in March at 1.5, the 10.3 stocks to usage. So a lot of the rally here has happened because of U.S. yields reducing, the derecho and things like that in the U.S., and then demand pulling our exports way up. So that's been the story here, is a demand pull market. If you look at exports year to date, we have already put on the books 2.33 billion bushels of what the USDA's estimate at 2.6. Advance believes this is light still, but we put almost the entire program the USDA thinks on 26 weeks of business halfway through the year on the books. And more importantly, if you look at that, is like, okay, it's on the books. What have we shipped? Well, of the 2.6 program, we've only shipped about 1,100,000,000. And of course, some of that is China. 287,000 is China. So they are taking stuff, but it's not uncommon. It's actually common for us in the U.S. to focus on beans in the first part of the year, get them off, because South America has a new bean crop in Feb, March. So the U.S. does Ocnov, Dec, Jan, Feb bean exports, focuses on them, and then usually our corn exports. Yes, we do some corn too, but the big part of the program happens in March, April, May, June, July, August. So it's back end loaded. So you can see that in corn. So we've shipped about not quite half of the program. The unshipped, we got a little over 1.3 billion bushels left. A lot is both unknown and China, close to 700 million bushels. So I guess one could say there's risk that you could see cancellations. But with how the safrinha crop is getting planted late, I doubt that China will cancel anything until they see not only their crop, but our crop well into vegetative state. And then lastly, if you look at when this program got built, this is a weekly chart of unshipped corn sales. In other words, when we put the book on, you can see it was a book coming into harvest was modest at 700 million bushels. And then we built it up to about a 1.4, all the while shipping. But the unshipped book grew, and there's that China big week purchase. For the USDA numbers, we need to average about 60.5 million bushels a week the balance of the year. And with our numbers, it's closer to 65. Looking at some other demand, you got ethanol board crush at the story all winter, basically from Thanksgiving to very recently here. I'll call this the Arctic blast of the month of February. Ethanol board crush was poor. Margins were poor. There was a bleed, if you will. Plants are slowing down. We're just not driving. That's the story. It's a COVID factor. So you just don't need plants to run flat out because the demand isn't there. And so the structures were there for the ethanol industry to kind of suffer through. Then we had an interesting phenomenon. We had one of the coldest months in the history of keeping weather records in the month of February in the Corn Belt. And actually in the high plains, central plains, and as you guys all know, all the way down through the deep south. And when that happened, what natural gas energy prices went up, mainly for heating purposes. And you remember, Texas not having enough nat gas and propane going up tenfold or more. And so what happened is anybody that was on a fixed usage of nat gas or propane that could not use it, could sell it back at these very, very high prices, were incentivized to do that. That'd be your soybean crushing plants, that'd be your ethanol plants. So if they could slow the plant down for a couple weeks and not use their propane or mostly natural gas, they could often monetize quite a handsome profit from that, and it'll help conserve energy. The market didn't really want it. So what happened is they did it. They reacted to market forces, slowed their plants down, and the ethanol industry, albeit low demand, drew on our stocks because the producers weren't producing, and the stock drawdown was massive. And so what happened then is, even though we're still, not at great gasoline offtake, it is improving, but we drew down our stocks. And normally in winter, we build them up for the heavy summer demand. The ethanol industry fully expects, with 3 million shots in the arms a day right now, that the summer driving will pick up. The lockdowns will ease, maybe even do some catch-up vacations. So they're expecting ethanol demand to be robust. And then on top of this, we're now seeing ethanol export demand. We had 3 ships sailing right now to China full of ethanol. And so the ethanol industry and the ethanol margins are vastly improved. So all these ethanol plants across the Corn Belt probably are going to run or scale back up to run and flat out to rebuild the drawdown in stocks that happened in that February cold blast, and B, anticipating a really good demand through the summer as we come out of the COVID hibernation, so to speak. So that's really encouraging. We got strong demand balance of the year for corn, for ethanol, strong demand for corn exports, and decent demand for feed. And if you look at that all, we think the USDA, ATI's numbers here, this is the March report, USDA at 1.5 carryout on the crop we're consuming through. And then we're down under 1.2 carryout, which is still plenty of corn, but it's, anytime you get down where your stocks to usage is getting down to 8% stocks left over versus the usage, that's tight. Even at 10.3 government number, that's tight. Looking forward to next year with a little bit of an increase in acres by the USDA forum, and we think we'll even find more corn acres than they're suggesting. Run through trend line yields and good demand again. Not you still have a hard time getting, and the USDA and ATI have much more than a 1.5 carryout number. So again, 10% stocks to usage at the end of next year if we raise a big crop on an expanded acre. So we have a lot of work to do to see this crop through. Looking at those stocks again, 10% stocks to usage as you look back, it's tight. And if the ATI numbers are more in the 8%, you're getting back to the Renewable Fuel Standard 2 mandate coming on in 10, 11, 12, when we took corn up to, try to ration it. So if you look at stocks to usage and then the price of corn, when you get down in these 10% levels, you try to look at analogous years. Economists like to put flat lines, but the reality is you can see if it gets much tighter than 10, like you saw in the RFS2, you get this kind of curve that happens. You're trying to actually ration usage. And beans and bean oil is very difficult to ration. The way they try to do that is through acreage increase. Corn, there are a lot more substitutes like wheat and other feed grains, and people around the world will try to find substitutes and use less. But even corn, you get down to a certain tightness and things can get really explosive. Again, my point isn't to predict we're going $8, but if safrinha crop or the US crop should disappoint from a good or normal yield, you could have explosive volatility. If we have I want to balance this, you could have bearish factors that come in. I hate to say it, but is China building stocks for a multitude of reasons? The contentious situation in the Chinese Sea, Taiwan, Hong Kong. Are they building a war chest? Yeah, we're going to have the Chinese meet with the U.S. new administration in Alaska shortly and start to get some dialogue back and forth, and we'll see. Maybe China won't. Maybe China will slow down on rebuilding their domestic stocks after meetings like that. Feel there's less contention with the Biden administration versus the Trump administration. I don't know. We'll see. Looking at soybeans, soybean demand has been amazing. And if you look at, there's 2 demand sources. You basically either export the raw beans or you crush the beans and use them domestically, oil and meal, or the co-products, or you export those co-products. Looking at the exports, as I mentioned, exports tend to happen in the front end of the year, and they sure have. We, of the 2.25 billion bushel USDA export program projected, we've already sold 2.21 billion. In other words, the program's almost totally on the books. And of course, a big part of that is the red bar, 1.3 billion, which is China. And there's still roughly 86 million of unknown. So if you look at all others, it's okay. It's not quite as good as 2 years ago, but 2 years ago we had tariffs on China. So the rest of the world came to America, and Brazil served China. So really big program. If you look at it, huge demand pull. Again, look at the big demand. It's China and unknown, which is most likely switched to China. If you dig into that, we have shipped 1.9 billion of the 2250. So not only is the program on the books, but it's almost not entirely, but nearly all shipped. So this is a program that's not going to get canceled. If you look at the unshipped amount, it's under 250 billion bushels unshipped, 47 China, 86 unknown. And yes, as I said, I don't think the Chinese they can shift or cancel and switch to a Brazilian or origin, but with Brazil having some problems here late, I just don't see it happen. It might be minor. We actually need some cancellations, and the U.S. needs some imports, because the result of this big demand is that our carryouts are very tight. Again, this program was built coming into harvest. We had over 1 billion bushels on the books, unshipped, grew it to 3, and we've been shipping. And now we're down below the 5-year average with less than 250 to ship. So a big program that's been lifted, and not much left, and not much risk of cancellations. If you look at the same stocks to usage and carry out numbers as we went through the late summer and into the current March report, you can see we started out with we thought we were going to have a 600 million bushel carryout. That's government numbers, and a 13.7 stocks that quickly in August SEP started to contract, because the Chinese put that big program on the books in August SEP as you came into harvest, and bean prices rallied from $8.50, $9, $10, and all of a sudden went black ink. So as farmers crossed the scale, they saw $10 to $11 beans, and of course aggressively rewarded it after 5 years of poor prices, of basically government relief, so to speak, in multiple payments. So farmers were aggressive sellers, and then Chinese demand continued, and we went from the 11 right on up to 14 and a half dollars since then, and we remain up there. So our carryouts are down to 120, and again, it's a demand-led rally. If you look at what happened here as we got into June, July, and started to rally beans in the red line, this is was November beans in US dollars. At the same time, the Brazilian real was devaluing. And if you look at beans in real, we were looking at a $9 price, and in their planting window, or decisions for their planting window, they were looking at $11 equivalent US beans in their own currency converted to. So they had a very profitable price, and of course put in record acres. And because it was right ahead of their planting season that this rally started to happen on the board, as well as their devaluation, had to have a multiplier effect to plant very profitable beans. So in some respects, the big demand that led the rally, their currency, helped them try to solve the world's problem of tightening global stocks. If you look at domestic usage, after looking at exports earlier, we really have a pretty good domestic soybean meal usage, and it's up about 11% year to date. balance of year doesn't do much. If you look at the current crush, and this right now is in the black, and the other years, just analogous years, are scattered around it, this would be $1 a bushel crush, which is pretty good margins. Anything north of that is very good, and anything above 60, generally speaking, is profitable. But as you get down to 60, you're more down to break-even levels. So we plummeted here around the Chinese Lunar New Year, and that we've stabilized a little bit, but maybe starting to see a little demand rationing from $14 beans and the cost of the co-products, oil and meal. So if you look at meal and you look at our meal exports, you can see our unshipped soybean meal right now compared to the last 6-7 years, it's off, it's waning. So maybe a little rationing starting to show up by foreign companies to buy meal. Oil, by all means, is not seeing the same thing. This is a 4-week average cash crush, average crush in China. And the Chinese Lunar New Year this year, 2021's the orangest looking, it plummeted. People are going to be very very observant here in the next several weeks to see if this picks back up or if it's sluggish. You must remember there's a lot of stories in China that the ASF, the swine flu, continues to creep in. Talk of sow pops down as much as 10%. Now, a lot of that is people, when you get swine flu in a region, they tend to hurry up and mark it as though they're to try to front run getting zero value. But baby pig prices have increased tenfold again. So there's something going on. And if their hog numbers are again being challenged to recover from ASF, that's obviously bullish meat exports, hog exports out of the US. If that comes to be, it's also probably one of the things that could lead to some caution about, whether they need more meal or more beans to crush if they slow things down. So there's another untold story. If you look at, as I mentioned, oil as a percentage of the share of the crush margin in 2021 here, the calendar year has just skyrocketed. So this is something that we typically don't talk about much in, on the ag news services, but soybean oil is a higher percentage of the crush. In other words, the value of it is more heavily weighted as to why beans can be in demand. And when we get up where 40% of the share is driven by oil, that's a pretty rare environment. You can see of the 10 analogous years, there's no other time that the oil share has been this high. We've gotten close a couple times, and people think that might continue to ascend. Part of the story here, and I don't have time to get into it, but your other oil seeds like rape, palm, sunflower, safflower, all the other oils that are used around the world, they're tight too. So substitutability for soybean oil is not readily available. In fact, some of the other oils that the Indians and Asian people use for frying are getting tight, and that's like center plate. They are not going to stop using oil, similar to we're not going to stop eating salad dressing. It's a very inelastic demand. Price usually doesn't ration demand. It tries to stimulate more production. Looking at the balance sheet in beans, you can see the 120 carry out after a year ago having 525 is quite an adjustment. $8.50 beans, $14 beans, and the global stocks that I'll show you in the next chart are feeling the effect of this tight US and of course global stocks. We're just a little bit tighter, but this is what I'd call pipeline. We can't get much tighter. On paper you could go tighter, but we're just going to need to import more beans or see some cancellations. We can't run out of beans. We can't run pigs and turkeys and poultry out of meal. looking forward with quite an increase in acres by the USDA form, 90 from 83.1. A lot of PPP again rolling forward last year and the year before. But the beans are definitely buying the acres. If you look at the bean corn ratio, 90 million acres raise a 51-ish type of crop. We struggled to get much over 150 million. So if you look at US stocks to use, they're very tight. And let's do that. So in July, not quite a year ago, we had almost a 10% stocks to usage US, and then the big giant demand pull market that's happened since then, led by China's thirst for our beans, and now some Brazil issues. South American issues has dropped it to numbers we have not seen, and why beans are a powder keg. And the world stocks too represent the same thing. We went from a 26.2 in the July stocks to usage global to 22. Looking at the same type of chart, if you look at other stocks to usage, as we get tighter down this end of the spectrum, price usually goes up, and you can see in other tight years, again, like corn, this isn't a flat curve. This starts to go, oh, we need to ration demand. Whoop, inelastic demand. We need to increase supplies or make it so expensive that we shut down industries. We, just make it too expensive for people to use it, maybe feed more corn and less meal or more other, find a way not to use the stuff. And this with an oil-led crush, that gets even more interesting because oil is food, as our pigs using meal. Looking at the bean corn ratio, this is 2021. We're up in that 2.61 or 2 no beans over decent corn. So that's a signal to the US farmer versus just a year ago to try to push your rotation to more beans and less corn. And that's what the USDA attaché and the surveys and economics would tell you to do. Beans are leading the way. Corn's still king. People like to plant corn, but the beans are from an economic standpoint are begging by 30-40 bucks an acre over corn returns on highly productive dirt to push back up your bean rotation. If you look at the USDA attaché in blue here is corn. We've been about a 90 million acre producer of corn static, i.e. this is kind of a supply burden market, give or take. And now with the high price of corn and oil seeds, we're going to try to plant as many acres as we can find. Mother Nature has some say in that, but we did have good fall prep, fall fertilizer app. Hopefully we have a really good quick spring to get bean and corn acres in without the huge PPP issues that we've had in the past. Low prices make it easier to switch to PPP. And of course, high prices make the decision to super juice, buy the best genetics, do all the agronomics you need to raise a big crop. Looking at La Nina in the US, what does it mean? And if you remember back to the original map, it doesn't mean much. I've failed to point it out, but you can have dryness through the Delta, Mid-South, and Southeast. And that usually leads to a problem the following year. In the Corn Belt, not much, or the hard red wheat belt, you really don't see La Nina have a trend that you can say, uh-oh, or okay, this is going to be a good year. And just looking at that, of the La Nina years, past 7 La Nina years, in the last roughly, 20, you 6 of those years we were at or above trend line, and only 1 year in 2012, the drought of 12 of Illinois, were we below. And on beans, it's a similar. 2 of the 7 years were much below trend line, but the other La Nina years were at or above it. So there's no real statistically significance. I'll put one slide on wheat here just to show you. They too, from a stocks to usage, are tight relative to the last 10, 15 years. So that's a substitution statement more than anything. And can we go grab those acres if wheat doesn't come out of dormancy in all parts of the northern hemisphere? Will they go and rip in corn and beans? Yes, they will. We're getting more into the marketing in the last few slides here. I just put together on the left axis is the price of beans, and beans are in blue. And in the month of February, we had the spring averaging for crop insurance price, and the market averaged $11.80 November 21 futures. That's the price that will be embedded in U.S. crop insurance protection levels, and then you protect you do your buy-ups, or you make your choices from there. Very, very high market. And in corn, that same analogy, only corn is over here in the reddish orange. In the month of Feb, it averaged $4.58, and currently we're in that a little bit higher than that. We're actually at 480, give or take, right now. And on beans, we're at 1242, right around 1250. So there's a gap from the $11.87 to the current market. The market's continued to go up since the averaging happened. And I would encourage people to think about that. Crop insurance is not a marketing end all. It's really a wonderful tool, and we're very fortunate. And the buy-ups this year have RMA involved, so there's going to be some buy-ups that are that put people in very good situation as far as managing revenue risk, and to have levels that if we had a derecho and had a zero yield, you'd still pay all your bills and maybe put up as much as a $60 or $80 bill in your pocket. Pretty amazing, really. So crop insurance is, of course, a benefit and needs to be aggressively looked at as your portfolio revenue management. But if prices continue, you still have to market the grain. If markets can go down and you go, boy, I wish I'd have marketed that stuff. Markets can go up and gap above insurance levels, and you should have a plan to protect that so it doesn't get away from you. So in summary, just looking at a few things, between COVID, South America weather, Chinese buying, S&D fundamentals have changed dramatically from last July, August to be tight U.S. and global balance sheet, a demand pull market that basically was a perfect storm of events that all appeared to be bullish. If you look at corn, wheat, and beans, we're expected to have about 3 million PPP, and Mother Nature will have something to say, versus 10 million last year and almost 20 million in 19. So all hands on deck. Prices saying planet, struggle with the spring if you have to. Revenue returns are big, insurance returns are big. Price volatility is going to be a big part of the coming marketing year. Fantastic opportunities to build equity if we raise a big crop and get it to market. And now the market's actually above insurable levels. So this is an exciting year. Keep in mind that high prices do tend to cure high prices, and also high prices have a trailing event to make cost structures escalate, seed costs, rent costs, fertilizer costs, because the demand for it goes up to try to produce the big crops. So we need to maintain flexibility and need to recognize that you got to protect, what will be escalating cost structures through your marketing efforts. As I mentioned, insurance prices are set. We've got a gap. Have you got a plan? Need to manage price irrespective of insurance coverage. My advice, which is to get risk management into your portfolio without price prediction, or to maintain control. And what that means is, on the old crop, continue to maintain control through the majority of long calls. In our program, we had March calls bought after marketing physical across the scale, or shortly thereafter on both corn and beans. And of course, in hindsight, that's been a big return back as prices continued to rally. $1.50 more on corn and $4 more on beans, or $3 to $4. In March recently went off, and we want half of our ownership back, at least out to July. Why July? That safrinha corn crop and your corn crop. We will know whether we got last half May and June rains on the safrinha crop that's planted. Actually, we'll know whether we got good April and May rains to carry a late planted safrinha crop into what is usually no more rain in late May and June, as well as see your crop with July options expiring the third Friday in June. You'll see your crop coming into early pollination. So you'll have a time on your side to control the old crop. And when you have control of old crop, it allows one to manage price risk and new crop. And this is an opportunistic, really good black ink, a market that we can expect to be volatile. Typically, what we like to do is, yes, incrementally price through cash, hedge to arrive, even some OTC structures, 20-30% here now that crop insurance is embedded. But more importantly, most farmers stop at that. It's like, well, I'm not going to do any more than 20-30% obligation because I just haven't produced a crop. We like to take our clients and use long options to protect that other 40, 50, 60, 70% to place floors under them. New crop floors, DISA 21, protecting the price. Now, it's expensive because you got a $5 or four, you got a 480 underlying D's corn, but that's the opportunity. And so the people that have got some trusted advisors in their workday, if I challenge anybody, it'd be to use regular puts on DISA 21 futures. You can use D standard, or you can buy short date them to, say, some of them to July, again, to see how we get through our planting. If we get all those acres in, if there's another black swan event, if we come out of COVID, if there's all the things that can happen in the production season of safrinha corn and US corn, having these puts on, even if they're short dated to July, helps you manage what is a good underlying price risk. Some seasonal averaging and Florida average pools that are offered are also embed a little risk management, especially the Florida average. So if you do manage those things, you'll welcome volatility and try to keep your bias or anybody's bias out of it by having risk management embedded. Quickly looking at some of those, again, DISA 21 is a 480 underlying. New old crop corn is at 530 when I snapshotted this. So you might, like on your old crop, if you right now today, you'd probably come back and replace it by buying 570 calls. Yep, 25 cents, and that's expensive, but that gets control back of the old crop, so you actually root for higher prices. And if that helps you sell the rest of your old crop corn, that's a real good strategy, because it is not far from contract highs. So get that sold, get it to the market. One of the reasons you want to do that is notice how May, July to SEP to DECE is inverted. You do not want to carry physical grain and see it get devalued in time. Get it to the market that wants it and re-own it a different way. Again, even if it's only 40, 50% of your total crop, to still root for higher markets. If you have to, you could sell like a $7 call for a nickel over the top of your 570, but to net it to 20 cents, but they're not worth much. Getting to new crop, so separate from old crop, the DISA 22 underlying, or excuse, DISA 21 is at 480. 480 puts are 50 cents. I can't look you in the eye and tell you to spend 50 cents on and have a 430 floor. That's just a lot of money. But 450 for 33, and maybe on 20-30% of that, sell a $6 call over the top, which would mean that you're sold at $6, $1.20 above, or about $1 above if you net the cost, maybe on 20-30%, and the rest just buy naked puts. I didn't put the short dated DECE up there, but you might be able to buy the short dated 450 for about half that price. Now, the key to this isn't just buy and forget. If the market keeps rallying, you'll want to have rolls in that if you can roll that 450 up underneath a rallying market and hike the floors up, spend about 2.5 cents per dime improvement on cost. So every strike you can roll up, if you can do it for 2.5 cents and improve your floor a dime for a 7.5 net, you'll do that all day. And if DC21 corn wants to go to $6, $7, $8 because safrinha crop doesn't develop well, or our crop doesn't develop well, you'll have full control of the rally and price. And if it goes down, you can defend it because your floors are now your marketing alternative. So with that, I just want to thank anybody that has been doing business with us, and also those for listening. Try to do this as needed. Have a good spring.